Hi, Chris Bertay from Signet Financial Management. I'm here with my partner, Jason Kohut, and we wanted to shoot a quick video to talk to you about a thing called sequence risk. Some people call it sequence of return risk. But I find that a lot of investors or self-directed investors or even some investment managers don't really talk about this, or they don't even know what it is. But it's something that's very prevalent in the world of financial planning, in particular retirement planning. So Jason, why don't you give us a quick overview of what sequence risk is?
Thanks, Chris. Sequence risk is also called sequence of return risk, and it becomes a danger as an individual starts to take withdrawals from their fund's underlying investments. Now, the order of the sequence of annual investment return is a primary concern for retirees who are living off of the income and capital of their investments. Let's say, for example, you do proper financial planning and you determine that you need about $50,000 a year from your investment accounts to pay your expenses and maintain your lifestyle. Say you have $1 million portfolio and you plan to be in retirement for 25 years. Taking into account inflation, you'll need close to about 5.5% rate of return. Now, if the market pulls back 1 or 2 out of those years, it may not impact you too much over the long term. But what happens if the market does pull back, say, at the beginning of that 25-year period?
That's a great question. What does happen?
Well, it can dramatically affect your portfolio's longevity and eventually lead to an annual cash shortfall. For example, 2 retirees with identical wealth can have entirely different financial outcomes depending on the state of the economy when they start retirement, even if the long-term market averages are the same. Now, here's a chart of 2 investors, both with a 25-year time horizon, both with an annualized 6% rate of return. The market pulled back dramatically on Mr. Brown at the start of his plan, and you can see the unfortunate outcome as compared to Mr. Green.
Well, that's a pretty dramatic difference. What can you do to protect against this? How do you weather the storm?
Yeah, that's a great question, Chris. At the most basic level, you want to diversify your portfolio away from higher risk stocks, which can see considerable fluctuations in value based upon the state of the market. Then you want to use a 3-bucket approach. Now, each bucket will be for a different purpose. For example, you're going to have short-term reserves, one for intermediate income and one for longer-term growth.
So the 3-bucket approach is something that standardly I know we do for clients on a consistent basis, but how do you know how much to put in each one of those buckets?
Well, it depends. We look at your age, your risk tolerance, Social Security strategy, pensions, size of your investment accounts, your goals, expenses, and a whole host of other factors do play a role in figuring how much to put into these buckets. It's best to work with an advisor or planner to help work this out.
Okay, so one last question. How do you know when you need income, how do you know which one of those buckets to pull money from?
Well, the answer is it depends. In general, though, start by taking money from the accounts or buckets with the lowest tax consequences first, so you can delay paying taxes. But the strategy certainly is more involved than that.
Thanks, Jason. That's some great information. And the market's been pretty volatile lately, and I know a lot of our clients are concerned about the recent downturn, and they're asking, is this the end of the 10-year bull market? Are we getting ready to start a new bear market? And the answer is I don't know, but either way, I want to be prepared. So we developed a 4-step retirement process that takes into account things such as sequence of return risk. And we'd love to share it with you. We're actually holding a seminar at the end of February to discuss our 4-step process and to prepare you and your family and your portfolio for anything that the market or life may throw at you. So we'll put our contact information below this video, and we'll also put information on how you can attend. Feel free to reach out, and we're happy to help any way we can. Thanks for watching the video, and we hope to see you next time. Take care.